Welcome, ladies and gentlemen. Boy, man, FOMC is probably the best live, and it's the only live that I look forward to. A, because I don't really talk too much, actually, let's be honest. The hour beforehand, we run our mouths quite a bit talking about lots of nonsensical madness, but we try and make sense of the madness. Welcome, ladies and gentlemen. Today, what's the schedule? FOMC. That's what we got. Now, if you are new passing through to this live, welcome. My name is Tino. You've tuned into Traders Reality. And today we've got the FOMC, and I'll be going live for the FOMC about 6:30 UK time, which will be around 1:30 Eastern Standard. So I'll be live during and before, of course, the FOMC, and we'll be live throughout until Jerome Powell starts running his mouth talking about the environment. Now, what we want to know is where we are with interest rates. There's lots of things happening, man. Is this the biggest day ever? It really is, especially for the financial markets. We know we're going to get a 25 basis point cut. Problem we've got is we're starting to see a little bit of a change in tone. Apparently, the sentence, we'll see what the data brings, is being thrown back into it. The problem we've got, guys, is pretty simple. The market's already priced in the idea of 3, maybe 4 rate cuts this year. But just because the market's priced it in, it doesn't mean that Jerome Powell has to go with what the market says. And you hear me say it all the time. The market is not the economy, and the economy is not the market. The market is not representing the economy. But is it, though? Is it representing optimism? Is it representing, oh, did I nearly press that? No. Is it representing where investors are? I mean, recession. Are we in a hidden recession? Courtesy of one of the gentlemen today in the membership asking me a question. Do you think we're in a hidden recession? We haven't got a problem with credit. So if we haven't got a problem with credit, then we've got nothing to be worried about. Now, I was tagged earlier on X, Jimmy Boy, mad love for this mention, in something that's happening to the European bonds. There's going to be an overhaul on the way the bonds are going to be managed in the Eurozone, which basically means $2 trillion is going to get wiped off the face of the earth. It's not going to go into bonds, but it's going to go somewhere else. Now, it might be doom and gloom, but I'm going to play something to you very shortly just to help you understand that logic. So, today, what we're going to do is break down a little bit of price action. I'm going to give you a couple of articles that are coming out, and then, of course, we'll be ending the live, and then we'll be getting ready for the FOMC live this evening. So make sure you tune in, hit the like button, subscribe, and all of that madness, and hit the bell so you get notified about tonight's live stream, all right? It's one of the biggest lives, and you don't want to miss that bad boy. So let's make sense of what's going on today. Is Bitcoin going to go up? Is Bitcoin going to go down? Excuse me, I've got a really itchy nose, and I've shaved this morning. But anyways, it's irrelevant. So let's get with some macroeconomic flavor. Let's start getting your brains operating. So usually today's not a day to start trading. You are literally going to be turning up to a casino and hoping that it all lands on red or the roll of the dice, which is why you don't really want to be trading during these times. Of course, any of you adrenaline junkies, like you degens, you guys are going to be wanting to trade this volatility. But word on the street is Bitcoin's going to slump. Don't shoot the messenger. Let me break it down for you. It says here that stocks treaded water as markets saw muted moves across the board. Now, this is where it gets very interesting. Look at this. It says here, with equities near record highs, the quiet tone belies the uncertainty over how the Fed will signal the path for rates. Okay? Then it says this. With a quarter point cut this meeting and a 3 more by April already priced in. So they're saying that the market's already priced in the quarter point cut that we've got. All right. So that's what we're getting today. They've also priced in the idea that by April next year, we would have already got the 3 rate cuts. Okay. But investors want the cuts to happen in this side of the year. Why? Because corporate finance is getting refinanced at these higher rates. It's going to cost them a penny or two if those rates are not lower. Now, before we start going into too many technical aspects of it, if the rates aren't going to get cut, the yields are going to be higher. And given with the current debt situation, with the US deficit going up and up and up, investors are going to demand more rates of return to buy US bonds, which naturally forces the yields to go up, which implies that the stock market is going to suffer from that, primarily the tech market, because they're subject to changes in yield, right? And he goes on to say this. The risk is that policymakers, dearly beloved Powell, is tasked with protecting the job market. Now, the job market is contracting. We know that because of the readings that came out in the non-farm payrolls last week. That came in and showed, a couple of weeks ago, that came in and showed a contraction in the labor market. Unemployment claims threw up towards 265,000. And of course, the unemployment rate went up to 4.3%. But this is where it gets interesting. It says here that the risk is that policymakers tasked with protecting the job market sound less dovish to keep inflation in check. Well, what's the alternative? If you're going to be relaxed about cutting the interest rates, that implies that you are dovish. All right? Or sorry, about in keeping the interest rates high, that means you are dovish because it means that you want to cut. All right? If you're like, hold on a second, we want to make sure that inflation is in check. We do not want to go above our dual mandated target of price stability and maximum employment. So in order to make sure that we don't have any problems over there, we got to make sure we keep interest rates high. In other words, if Jerome Powell gives the slightest bit of inclination that he is hawkish and then goes on to say that we're data dependent, ladies and gentlemen, we're going to be in exactly the same position as we were before. We just got a measly 25 basis point cut. And that does nothing for the marketplace. It's like Powell is satisfying Trump by giving a rate cut. Now, is the rate cut worth it? No, not in my opinion. Now, if we get 50 basis point cut today, just out of the blue, and it completely throws everybody off, the market will drop because it'll be like, hold on a second, they didn't tell us this. Out of the blue, you can't be cutting rates by 50 basis points just like that. Sounds great. It does sound great. It means that treasuries are cheaper, so that encourages naturally investors to start getting involved in the treasuries, but it also implies there's a problem with the economy. But apparently the economy is fine. And we know that because GDP has expanded by 3.3%. But that also means that the amount of expenditure that the US has done this month to the sum of $345 billion, which is 7% of the actual GDP, that tells you that they're spending way more than what they are earning. Remember, for every dollar that the US earns, it owes 126% on top. So they're not exactly making any money. Print, 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 ladies and gentlemen. That's what we're always going to be doing. Now, you've got Donald Trump and his BS going about with the actual members of the Federal Reserve, really challenging the idea of independence for the Federal Reserve. He's already got 3 crypto-friendly participants getting involved in the board of the Federal Reserve. So it's literally, he's going in to infiltrate, all right? He is breaching the Federal Reserve. And Jerome Powell doesn't look too happy. Now, I'm going to talk about something, and I want you to listen to this. Check this out. You know who this guy is? This is Jamie Dimon, right? And he has a thing or two to say about cryptocurrency. But listen to what he said a little while back.
You are going to see a crack in the bond market, okay? It is going to happen. And I tell this to my regulators, some of who are in this room, I'm telling you it's going to happen. And you're going to panic. I'm not going to panic. We'll be fine. We'll probably make more money. And then some of my friends will tell me that we like crises because it's good for JP Morgan Chase. No, you are going.
Okay. So from that comment there's going to be a crack in the bond market. Finance a lot has said that he hasn't specified which one. You only naturally assume that he's talking about the US bond market. But just as of late, we're now starting to see a change, courtesy of Finance a Lot. It says here that a $2 trillion shock is coming for the Euro bonds. All right. Now, it says here, a Dutch shift from defined pension benefits will remove decades demand for 30 and 50-year bonds. All right. So now it's effectively going into what is called, let me just get it right, defined contribution. So from defined benefit, it's going to defined contribution. What's the difference between the two? Well, ladies and gentlemen, first things first, when you buy bonds, usually what it says is you don't need to back anything with it. All right. There's no liability and it's all on the fund's liability. But now with this change in the way they're doing things, it means now defined, what was it again? Sorry. Defined contribution means that if you're going to start buying bonds, you've got to have the liquidity behind you to back it. That's no good. So where are you going to go? You're going to go into asset classes that you can technically afford because you can appreciate how big the bond market is, right? That's good news and it's bad news. Why? Because if investors see it as a problem, it could mean that the euro slumps and the dollar goes down. But if $2 trillion is going to effectively come away from that bond market, what does it do? It increases the yield on the euro. Now, what we're hoping is that the yields on the euro don't go up because people are concerned. We're hoping that the yields on the euro go up because investors are taking away from the original pension funds and the bonds and going into asset classes because they don't want to carry the liability. So as much as this sounds like a really big problem, it's one of those wait and see modes. Now, Dimon is adamant that there's going to be a crash in the financial marketplace or the bond crisis. It's going to happen. We've already had a bond massacre back in 74. History does repeat itself. We don't know when, but it bloody sure well rhymes, right? So after that, I started to think to myself, right, let me just go check out what's going on in the Eurozone. Of course, we've got the problem with the French government and what have you, but the French government fallout as such is being shown in the bonds, okay? Because investors are like, whoa, if there's no stability, then we're not going to be parking our money over here, okay? Tino, can we expect 50 basis point cut? Listen, I'll speak to Jerome Powell later on, my bro. Just sit tight for a second. So this is what I decided to do. I went over and had a look at some information. European 10-year bond yields. What are they doing? They're going up. So it looks like some investors could be starting the process of offloading with this change from defined benefit to defined contribution. Okay, remember, it means now when you start buying bonds, you've got to have the capital behind you. Before there was no liability, now there is. So that's really going to encourage investors to come out of bonds and go into asset classes that they can manage. And looking at the way things are with the Eurozone, you can see that the European 10-year bonds are going up across the board, okay? It's going up. So that could mean that they could be actually starting the process. Next chart is the Eurozone loans to households. Why is this important? Because it's going to tell me if there is a problem with credit, because it's only going to be implied on the actual bond market. If investors think there is an issue, they're going to go sit into the bonds. The yields are going to go down because they're going to want to seek safety, okay? So from a financial stability point of view, I'm looking at this and I can see it's starting to go up. Loans to households are actually starting to rise. But you've got to remember, if the prospect of yields going up in the Eurozone are coming in the future, then it asks the question, why on earth has the ECB been cutting their rates so aggressively? It could be a very good play, in my opinion. Now, think about this, right? The ECB have been cutting the interest rates for quite some time. The next cut is coming very soon, and they're currently at 2.14%, right? So if this change in the way the bonds are going to be sorted or liability holding bonds, all right, is naturally going to seek the yields to move higher, well, if you've already got high interest rates, it's going to really squeeze you. So you better cut those rates quickly, get them down to a level that when this event does happen, the yields can only go up to manageable areas. So it makes sense why the euro will be cutting those interest rates so much and so aggressively. It's like they're preparing for this event. So equally now, with the loans to households coming into play, you can see that it's going up. So money is being put to work. So we don't really need to be worried too much about credit in the Eurozone because it's not peaking out. It's just starting to go up. Why? Because the euro is now carrying more yield, but well, in terms of its value itself, but it's costing less to borrow money. That's a healthy marketplace in principle. Now, this chart right here is the composite indicator of systemic stress, all right? In other words, it's like a volatility indicator, all right, to tell you where we are. It says here that the composite indicator of systemic stress are indicators used by the European Central Bank to assess financial stress within the Eurozone. Well, it doesn't look like we got that much stress coming into play, ladies and gentlemen. Don't really need to be too worried about that. Let's just quickly enlarge that. Go down. You can see, what the hell? You can see over here, nothing to worry about. Doesn't look like there's that much stress happening in the marketplace now, is there? Yeah, I'm cool with that. So the next question is this. What does it mean for Bitcoin? What does it mean for the US? What does it all mean? Well, ladies and gentlemen, check this out. Two worrying signs. Oh my days. Bitcoin is going to wet the bed. So this is all part and parcel of what I'm actually talking about today and what I think is going to happen to Bitcoin. So we've got a couple of stories here that are in favor of Bitcoin going up and in favor of Bitcoin going down. Okay, so check this out. It says here, experts warn of possible sell the news drop after the Fed's projected rate cuts, with scenarios pointing to a dip below 100K. God forbid. God forbid that Bitcoin is cheaper. We don't want a cheap Bitcoin. We want an expensive Bitcoin because I know it works for your portfolios. You know, when you see all the posts on people saying, when I told you to buy Bitcoin at $200 and now it's at 150,000, whatever. All right, I told you to buy Bitcoin at $1 and now it's at 116,000. You know, all those posts are all coming out right now because they're accepting the fact that Bitcoin is valuable, which is naturally going to make you think, oh my God, I don't want it to go above 116,000 without me being on the train or the gravy train to enjoy it, right? So they're all talking about the idea that maybe Bitcoin could drop down to 100,000. But it says here that the supply on exchanges is actually, it's limiting. It says here, exchange reserves hit an 8-year low and assets in the MVRV ratio stays in healthy ranges. So effectively, the MVR ratio is market cap to realized cap, is effectively how many people are sat in profits, what are they doing with it, are they cashing them out, what's going on? And it says here that suggesting limited immediate selling pressure and more room for growth before hitting cycle tops. Okay, so that's what the MVRV is saying. Now, it says here that, of course, with the exchange coming up, okay, so the supply of Bitcoin coming down, that's great news because it means they're consuming Bitcoin. We know that's the case because we go over to the ETF and we know that that Bitcoin over there, where are we? Here we go. So currently 763,699 Bitcoins are stuck there. All right. Over 1 million and a bit, nearly 2 million just under about 1.5 million or so in Bitcoin holdings in the ETF. So that's good news, ladies and gentlemen. All right. But why are they talking about Bitcoin dropping down? I mean, what's the case for it? This is what I think is going to happen. You've effectively got, hold on a second, you've effectively got this story, right? That when the market got the rate cut on the 18th of December, back in 2024, the picture itself was mimicked, all right? So we just go over to NASDAQ. I don't want to say this to you all just to get you a little bit concerned, right? But this is where we are right now. So just those of you that are new coming into the live stream, just look at this chart. You can see that NASDAQ right there has got a gap, okay? Now, let's just go back to December 2024, all right? When we had the rate cut, in December 2024, when they actually cut the US rates from 4.75 to 4.5%. And that was only a 25 basis point cut. So we are, in essence, it's just, look, take this with a pinch of salt, but let me just do this for a second, right? That is where we are right now, okay? That's where we are right now, okay? Then, right? Now look at where we are right now, okay? So that's now, and that is then. That's then, that's now. I mean, even look. They even gave us the same wick, that little wick right there closing half of the gap. There it is right there. I mean, is it going to happen? Because we are going into a rate cut of 25 basis points. But what are they going to tell us about the future? All right, if you don't like what I'm going to say, you don't like what I'm going to say. But this is what I think is going to happen to Bitcoin, right? We look at Bitcoin on the higher time frames, all right? There is a beautiful vector candle up here. I expect Bitcoin to attack this range, okay? I anticipate it. But it could be done on what Powell says, okay? If Powell comes in with a hawkish tone, right, that's going to be a problem for Bitcoin, but you won't see it come into play straight away. Bitcoin will start to rally. It will make investors believe that prices are dismissing what Powell is saying. They don't care. But just because Bitcoin has been in a consolidation, investors are looking at the idea, okay, we've got a limited supply on the exchanges. That's great news. Perfect. There's accumulation on the ETF itself right here. Where are we? There we go. Accumulation. We know we're hitting highs on the ETF itself. So it gives me every reason to believe that Bitcoin is going to hold its range. Okay. We don't need to worry about tonight, as in after the FOMC, because Bank of Japan ain't going to be doing anything. That's good news. But we are going to be waiting to see if they are going to cut or increase their interest rates in October. That's what we're looking for. We know they're not going to increase at this meeting, which is happening tonight after the FOMC. And it's actually at 6:30 GMT, all right? 6:30 a.m. GMT. So just keep an eye out on the Asian session at that time, right? But they're not going to do anything. So that's good news. So it's all on the FOMC tonight, right? However, this is what I expect. This is the sort of logic that could come into play with Bitcoin. Bitcoin will start to pump, right? And when Bitcoin pumps, it will create the illusion that people are getting excited about what Jerome Powell has to say. It could even pump while he's talking. He's going to start talking about the dual mandate. He's going to start giving out the projections. He's going to be giving out the logic of the dot plot story. So you go to the chart over here. He's going to pull this up. He's then going to give us the projections of where they are economically. Okay. He said last time that the expectations of inflation were around 3%. And that's pretty much where we're heading to, given the last reading was 2.9. So Powell is right yet again. But this is what I expect to happen with Bitcoin. I believe Bitcoin is going to do a stop run. It's going to pump up. Everyone's going to be caught off guard because it's going to be claimed as the hedge against inflation. Everything is great. And Bitcoin is going to rip back down. I hope that's not the case. I hope that it can sustain itself and break away into this red vector candle, because that's what I want to see Bitcoin do. I want to see it go and claim that red vector candle. How many of you are in the belief that Bitcoin is actually ready to claim its all-time high? Now, given that the history of the way the market operates, I mean, it is a bit of a problem for us when you've got NASDAQ doing this behavior on the last rate cut, and we're going into exactly the same thing. I mean, who would you tell? Why would they do exactly the same thing on the last rate cut? It just doesn't make sense, does it? They've gapped up before the rate cut, and we're getting exactly the same cut. We're exactly in the same position as we were before, around 3.2, 3.4% on inflation, okay? It was starting to come down. So that's why they cut the rates, and they cut it by 25 basis points. Since then, they didn't do anything after that. All right. Well, they did cut it down a few more times, but the market welcomed that. That's why we need a massive rate cut to help the finances of the world. But it can't come across as too much, because it will make investors think there's a problem. So all I'm saying to you all is this, ladies and gentlemen, when it looks for Bitcoin, when we're looking at Bitcoin price action, just anticipate that it's going to be a wild ride. I expect them to rally up to then bring it back down. And then in Asia, that's when the market can effectively reset and price in what's going on. So you're really going to be looking to buy Bitcoin after the event, because they're talking about it being a sell the news event. And just because they're talking about it, it's all going to be based on what Jerome Powell is going to reveal. All right. If he does reveal a hawkish tone, that's bad news, full stop. All right. Dollar's only going to move back up, ladies and gentlemen, because it means that the yields on the rates of interest are still going to be higher. That means that our good old euro at its yearly highs is going to enjoy a nice little flavoursome drop to the downside, recover the green vector candle to find base. That means investors will be transacting on the US dollar again, which means that if Bank of Japan are not going to be increasing their interest rates, that means the rates are going to stay the same. The dollar is only going to shoot back up again. We've got a very interesting range coming into play with the dollar, given that it's coming into this year's yearly lows, okay? And it hasn't yet taken it, but euro has. So that could mean there is underlying strength in the dollar. So we got to be very careful, because dollar's not selling off. Tonight we will know, ladies and gentlemen, if that logic is going to come through. I wouldn't be doing anything until FOMC comes into play. And if Bitcoin does pump up, and it pumps up majestically, then okay, well, add caution, caution to caution, right? But if you're going to take the risk and get Bitcoin right now and buy it before FOMC, just be careful. If you are using leverage, you're going to get smacked about. They'll create a wick up and down. And as I said to you all before, we needed Bitcoin to drop before FOMC, not rise. It needed to drop, because then that would fit in line with the story of they've been buying to effectively sell it. Let's go and have a look at the order flow. In front of you is Bitcoin's order flow right now. Your book is empty. Look at it. Not that much. Just a few million down below. Whoa. Hold on. Did I just see what I thought I saw? Was that 65 million? Wait a sec. Let me just go over to this. Large limit order. Here we go. In the order book right now, I'm going to read this off for anyone that might be driving or they don't know, can't watch the chart a second. The largest order that I can see on the book so far is at 115,843, and that's for 4 million. Okay. After that, you've got 5.83 million at 115,747. So there's not that much liquidity on bid side, right? Keep on going down. I'm not seeing anything, nothing, no. 5 million again at 115,407. That's nothing. Looks like an iceberg. Another 5 million at 115, 118,000. These are all bid orders, people to buy Bitcoin. And then you've got, okay, and then you've got 6 million at 114,888. If they think that Bitcoin is going to slump to 100K after post FOMC, then that is shocking. But looking at the offer side is going to put things into perspective. The highest offer amount that I can see is 5 million yet again, 6 million. So 6 million at 117,200, 5 million at effectively 117,000 on the nose, okay? After that, we don't really see any big major orders in offers. So that tells me straight, oh, here we go. 118,000, you got $15 million worth of Bitcoin to be sold. All right. So our range is in principle 118,000 right there and 114,000. That is the range where the liquidity is currently coming into the market, but it's not that much liquidity. That's the issue I've got. And it tells you that people are still sat on the sidelines waiting to work out what's going to happen next. I believe that we're going to see a pump. That pump's going to be equally then met with resistance, and then Powell starts to speak. Bitcoin goes a bit crazy, rips up, rips down. You don't want to try and guess that. You can't. No one's going to know what Bitcoin's going to do. You can make the assumption that it's rallying to the upside. Awesome. All right. But you remember what we said before? What if this is all part of the retrace from the M formation? Drop retrace level 1. Logic says it should come back down. That should be the logic. Today, we will know if that is the cyclical play. And if Bitcoin does sink from this level, we know that this market level right here is going to start a cyclical move to the downside, which in turn would lead to drop level 2, retrace, drop level 3, retrace, continuation back up to claim the all-time highs. We are looking like that could be the case, but today will reveal it. The only way that the logic of the market not being in a markdown phase and it's going to sell off is if this price range sustains itself and Bitcoin breaks away and clears the all-time high. Word on the street is that they're actually expecting $175,000 Bitcoin. Why? Just purely from technical analysis. They're expecting it from this pitchfork and this idea that the increases, decreases, Q4 bullish target at 175,000 between October and December, maybe in line for another rate cut, possibly. That's what we're looking for today. So people are putting the logic together that as we go into Q4, yes, some realized bank losses and gains are going to be coming into play. And that was the reason why the stock market crashed in 2018 when they kind of declared it and said, look, we're at a loss of 256 billion. Now it's nearing to 600 billion and nothing's crashing, everything is great. What's so different about the debt that was owed before to the debt that is owed now? Redefined recession? No, we're not going into a recession. No, it's just, don't worry about it. Don't be silly. You know? It is quite a funny time, guys. And look, people are using, look at this. See this chart here? August, September, that's where we are. It led to an October, December pump. So the logic says August, September here, it's led to an October, December pump. But we didn't have any rate cuts. Did we have rate cuts from there? Yes, we did. That was 2024. Yeah, that was your 2024 rate cut, right? From 4.75 to 4.5%. That's what led that drop to the downside. So this chart is saying it's going to pump in October and then December it's going to drop. Today, we will know if the pump's going to start. And if Powell is hawkish, we've got a problem. If he's dovish, ladies and gentlemen, that's going to be good news because then the market will get everything that it wants. It wants the rate cuts. They've priced it in now and they're waiting to see if they were right. Because if they're not right, the market's going to wet the bed. But it will equally return straight back up. You just got to ride that wave. That's where we are, ladies and gentlemen. Any questions? Don't forget about the Japanese market policy on Thursday. Could be grand. Yeah, no. I'm not worried about it. Nah, What I'm worried about is if they say, yes, we're going to increase our interest rates in October. Oh, man. If they say that, hear me out. Imagine today we don't get the information that we want. The dollar shoots up. Yields collapse because everyone's rushing to buy dollars, right? And get into the bonds because they've cut the rates, right? But then they've said we're going to keep the rates higher for longer. Dollar climbs. The yields then shoot back up because they're keeping the rates higher for longer. Hold on a second, Tina. You just said it was going to go, bonds are going to go down, yields are going to crash, bonds are going to go up, yields are going to go down. Why? That's how quick it can change in terms of sentiment. They'll give us the cut, the market reacts, right? Then they'll say that you're not going to get more cuts in the future. Okay, let's go back into dollars. Yield's going to go back up again, right? Euro's going to take a shoe bag lower. Bitcoin's going to go lower, right? Dollar keeps on going up. Bank of Japan turn around and say, all right, cool, where we at? So the dollar's getting up again. That's bad news for us as Japanese because we can't really have an appreciating dollar. And does that mean we now need to see the dollar strength? I mean, if it goes into against the yen, right? If dollar yen goes into areas of anything above 150, we've got a bit of a problem because then Bank of Japan need to start doing Forex intervention, which is what Donald Trump hates about the Japanese policies. Doesn't like the fact that whenever the dollar goes up high against the yen, they can just buy a ton load of dollars and then flood the market, which will then naturally deflate the dollar and, of course, inflate the yen, right? That's why he's really cheesed off about Japan, because he said it, all right? And then we all paid attention to the tariffs, okay? But that's really what he's trying to do with Japan, to get them to stop doing that. But if Japan have every reason to do that, then that's exactly what they will do. Like I said, if the dollar goes up, it's bad news for Japanese, all right? And they turn around and say Thursday night, tonight, right, that they're going to increase their interest rates in October. They are telling you to unwind from the carry trade. That means anyone that's invested, so your dollars end up going up, FOMC, and then anyone that has invested with yen into dollars and bought stock, the stock market will drop. They'll get those dollars, put them into their conversions and currencies and your swaps, and then they'll go back and sell those dollars into yen to repay the outstanding loans that they've got with them, rather than absorbing the increasing cost which is pending in October. That's what we don't want. We don't want that. We don't want the Bank of Japan to increase their interest rates because it will lead to a flush. Can you absorb it? Then you'll welcome it, because if you're like Warren Buffett, sat on the sidelines with $365 billion waiting for a discount, then he would welcome that. If you're waiting for a bond market crash, he would welcome that. So if you want your Bitcoin to be cheaper, welcome crisis. Jamie Dimon said it. We make a ton load of cash on crisis. Welcome the crisis, buy the blood. Don't be stuck in the ideal Bitcoin needs to go higher to the moon and all that dog shit. Be realistic with your expectations. You're playing one of the most sophisticated environments, industries in the world. All right? Make sure you subscribe, ladies and gentlemen, and tune into tonight's live stream for the FOMC. I'll see you at 6:30 UK time, 1:30 Eastern Standard. Mad love and respect.